In the previous lecture, we have been talking about the theoretical background for autoregressive models, and in this lecture we are going to take a look how to use it on financial data. So first of all, let's install QuantMod if you haven't installed it yet, and then of course we have to require the package QuantMod. So this is how we can download data from Yahoo Finance. So let's run it. Okay. Then of course we can use the get symbols function in order to download data from Yahoo Finance. In this case, we are going to fetch IBM related stock prices. Then of course we can plot the adjusted closing prices of IBM. So if we do something like this, then we end up with the adjusted closing prices of IBM within the range 2007 up to 2020. Okay, let's calculate the log daily return. So what do we have to do? We have the returns as the diff of log adjusted closing prices of IBM. So first of all, what is this diff function? If we have a time series, then the diff function is going to use t plus 1, so the next item minus the actual item. So this is how we can calculate the differences of the neighboring observations. And of course, if we are dealing with log values, then what does it mean? If you are familiar with the features of the logarithmic function, then it is the same as log xt plus 1 divided by xt. This is the so-called daily return if we are dealing with financial data, and the logarithm is going to yield the log daily return. So this is exactly what we have been talking about in a theoretical section. So this is how we can calculate the log daily returns with the help of the diff function. And of course, if we plot the returns, then we end up with something like this. As you can see, it is very similar to a stationary process, of course, because we have calculated the log daily returns. So this is what we have been talking about in one of the previous lectures, that we can transform a non-stationary process into a stationary process with the help of the differencing transformation. So as you can see, we can do something very similar with the help of the diff function. So this is why using the log daily returns is extremely useful, because if we are dealing with log daily returns, then basically we are achieving this transformation that can transform a non-stationary process into a stationary one. And this is why we end up with something like this. It is very similar to a stationary process. Okay, so that's all about the log daily returns. So if we have the stock prices are usually non-stationary processes, but if we are dealing with log daily returns, then these returns are more or less stationary, which means that if we plot the autocorrelation function as far as the returns are concerned, and of course na.action is equals to na.omit, so we would like to get rid of the invalid values. So if we plot the autocorrelation function, then as you can see, we can end up with something very similar to white noise. So what does it mean? When the lag is equals to 0, the correlation is 1, of course, but for other lags, the correlation is very small. Of course, there are some lags when there is significant correlations between the observations, as you can see. So when the lag is equals to 1, for example, when the lag is equals to 8 or 9, so these are significant correlations. But anyways, let's try to build an autoregressive model. So we have the model which is equals to AR. Of course, we have to deal with the returns, and we would like to get rid of invalid values. So if we build an autoregressive model like this, then we can print out several parameters of the model. Such as, for example, if we print out the model itself, then we are going to get the coefficients. So we have 1, 2, 3, 4 up to 10 alpha parameters. So what does it mean? It means that we are dealing with an autoregressive model with order 10, which means that our model combines 10 observations in the past. So we have alpha 1, alpha 2 up to alpha 10. And basically these are the coefficients we have managed to calculate with the help of the R programming language. Minus 0.0426 is alpha 1. Then we have 0.0139, this is alpha 2, and so on. 1. So these are the so-called coefficients. And by the way, if we get the order of the model, of course we end up with 10. So this is an autoregressive model with order 10, which means that we combine 10 observations in the past. By the way, if we have AR, so the model $AR, then this is how we can get the coefficients one by one. So these are the alpha parameters again. We can calculate the variance, so basically the error of the model. So these are the variance parameters. And what's crucial that we can plot the residual series. So what does it mean exactly? The residual series is equals to the actual values minus the predicted values by the model. So basically this is how we can calculate the error of the model. Of course, if the model is working fine, which means that the autoregressive model is able to explain every detail of the underlying time series, then it is going to make good predictions, which means that the predictions will be very similar to the actual values of the time series, which means that the error terms are very small. If the predictions are not matching with the actual values, then the error term is high. So the residual series is extremely crucial, and we can get it with the help of the $resid. So these are the values, and the smaller the better. And of course it is quite a common approach when dealing with regression that we analyze the autocorrelation of the residual series, because if there is no autocorrelation within the residual series, which means that they are more or less independent of each other, it means that our model is working fine. So what do we have to do? We have ACF, so autocorrelation function of the residuals. And of course, we would like to get rid of invalid values. So if we use something like this, then we end up with the autocorrelation of the residual series. And as you can see, it is very, very similar to white noise. This is what we have been talking about in the theoretical section, that we can handle the residual error series, which is the time series minus the predicted time series by the model. And if there is serial correlation for the residuals, then it is a good indicator that our model is not good. A good model can explain this autocorrelation in the residual time series. Of course, in this case, it is working fine because most of the correlation values are within the 95% confidence level, and of course it may happen with 5% probability that these values are outside the scope of the confidence level. So for example, here when the lag is equals to 22 or 23, of course the correlation is outside the scope of the confidence level, but it is not a problem because it may happen with 5% probability because we are dealing with 95% confidence levels. Okay, so when we are dealing with IBM stocks, it is working fine. What if we are dealing with S&P 500? So this GSPC stands for S&P 500, which is an index. So it contains the 500 most relevant companies within the United States. So if we use something like this, we have the GSPC. Okay, then we can plot the adjusted closing prices of GSPC. So these are the adjusted closing prices of the S&P 500 index. Of course, we can calculate the returns of S&P 500. So let's calculate the log daily returns. Okay, and then let's plot the autocorrelation function. So as you can see, when dealing with S&P 500, there are significant correlation between the log daily returns. So as you can see, when the lag is equals to 1, there is a significant negative correlation. When the lag is equals to 7, when the lag is equals to 9, when the lag is equals to 15 and 16, there is a serious correlation between the observations, which means that our model is not the best one possible. Of course, again, we can use an autoregressive model and we can print out the model and we can use the order. So in this case, as you can see, we have to use an autoregressive model with 18 parameters, and this is a typical case of an overfitting. So we don't like models with 18 parameters. The more parameters we have, the higher the likelihood of overfitting, which means that the model is working fine on the training data set, but it is not going to work fine on the test data set because basically we are modeling noise. So there are so many parameters But anyways, let's use the residual series. So let's take a look at the residual series when dealing with S&P 500. As you can see, there are values that are outside the scope of the 95% confidence level, which means that this model is working fine when dealing with stocks such as IBM, but it is not working fine when we want to understand and grasp S&P 500 related index. And of course, this is why we have to talk about more complicated models. Thanks for watching.